Hi, I'm Rainey with Finance Strategists. In this lesson, we're going to cover
an asset is a resource that a company owns that provides economic value. This includes cash, equipment, property, rights, or anything that a company can expect to generate revenue or reduce expenses. There are four main types of assets. The four categories are short-term or current assets. These are assets that a company expects to be able to convert into cash within 1 year. This includes cash and cash equivalents, inventory, accounts receivable, and some prepaid expenses. Financial investments. Investments in assets and securities, such as stocks and bonds, also count towards a company's assets. Fixed assets. These are long-lived items like equipment and real estate. In contrast to short-term assets, fixed assets are expected to last beyond a year. A fixed asset is often a capital expenditure. Although the business will incur the expense year one, the expense will generally be incurred evenly over the useful lifetime of the asset on financial statements. Intangible assets. Resources with value but without substance fall into this category, such as trademarks, patents, and intellectual property. Assets are recorded on a company's balance sheet, along with liabilities and equity. Equity refers to the amount of money contributed by shareholders, plus retained earnings. Liabilities are balances that effectively reduce a company's overall spending power, such as outstanding loans or debt. For accounting purposes, a company's value is equal to their assets minus their liabilities. When a company spends cash on an asset, the value of the assets section of the balance sheet remains the same. As an example, if a company spends $10,000 in cash on a new vehicle, their cash is reduced by $10,000, but they gain an asset worth the same amount. Before accounting for depreciation, the total value of their assets remains the same.
For more information, visit www.financestrategists.com. Finance Strategists, strategies for your future.